Good afternoon. It's that time of the week again, where we have the privilege and the opportunity to bring a great guest speaker to our clients and to everybody that's listening in, all the new people that are joining us from all over the country and some from abroad. So, yeah, it's Tuesday, 4 o'clock. We'll be having these webinars every week at this time. So please keep on joining us. Thank you for joining us. We want to start by thanking Mr. Peter Duminy from Sanlam Private Wealth for taking time out of his schedule this afternoon to present to us, to our clients, and to all the people that's joining us and trying to get some value and make some sense out of what's going on in the markets currently. Just a quick idea or update on why we use Sanlam Private Wealth. Sanlam Private Wealth, it's owned by Sanlam since 1998, all right? Sanlam Private Wealth manages 74 trillion, or in Afrikaans, miljard. The Pretoria branch where we mostly operate out of is the one where Mr. Duminy operates out of as a portfolio manager. And there's 8 branches all over the country. So we have this opportunity or this facility for our clients. And the reason why we want them to talk or speak to our clients are a lot of clients, or most clients, let's say 99% of clients, if you're in a moderate portfolio, moderate aggressive portfolio, doesn't matter which one, in some or other form or way, you've got exposure to equities. Even if you don't have a direct equity portfolio with Sanlam or with anyone else, you've got exposure to equities, and it's a very, very valuable asset class to be in, a very important asset class. And hopefully Peter can bring some clarity on why it's important to be in equities currently and how to react or how to manage the equity component within a portfolio. So without any further ado, I'm going to ask Mr. Duminy to join us on screen. And yeah, don't get a fright. He is actually logged in under someone else's name. The reason being his laptop was giving some problems. So he is not Marina. Marina is the manager in the Pretoria branch. So I want to ask Peter to come on screen, and while he joins us, just give you a little bit of indication on who he is. Peter holds a BCom Honours degree in economics, and he's a member of the Investment Analysis Society of South Africa, as well as a practicing stockbroker and member in the South African Institute of Stockbrokers. Peter commenced his career at the South African Reserve Bank in Cape Town, where after he progressed to Treasury in Pretoria. In 1994, he joined the stockbroking firm Smith, Borkum and Hare, which morphed into Merrill Lynch Private Clients in South Africa. In 1998, he joined forces with BDO and created Cornerstone Fund Managers, which Sanlam Private Wealth bought in 2009. Since 2009 until 2019, he fulfilled the dual role of portfolio manager and branch manager. In September 2019, a professional branch manager, Marina, which Peter is logged in under, took over there. Subsequently, Peter's sole role has been assisting his colleagues in managing the client's share portfolios, both locally and internationally. So enough from me. We keep these information sessions short and sweet. So I'm going to get rid of myself off screen. I'm going to hand over to Peter. Peter, thank you very much for joining us. We really appreciate your time, and we're going to do a Q&A during the course. So please put your questions at the bottom, and then at the end of the presentation, Peter will answer them on screen. You'll be able to see the questions. So if you like a question that someone is asked or someone has asked, please give it a little bit of a vote, and then Peter will answer these questions at the end of the session. Once again, thank you for joining us, and we hope that this adds tremendous value.
Thank you, Barry. Can you see the screen that I've shared, and can you hear me, Barry?
Yes, we hear you fine, and we see your screen that you've shared. Thank you very much. Just quickly to our clients, so everybody's listening, if you go to the top of your little screen, you'll see there's a focus screen. If you want to reduce the video of the presenter and make the presentation a little bit bigger, you can click on that little block that says focus screen as well. So thanks, Peter, and enjoy, everybody.
Thank you very much, Barry, for that introduction. I never thought it would be fine to speak to my computer for an hour in one afternoon, in my lifetime anyway. So this is all new to me, and I apologize if I stutter a little bit or if I get that you're falling asleep on the other side and I'm rambling along, so apologies. But thank you very much for the opportunity. The Good Forsure Bluestar business. It's really an honor and a privilege for me to represent my branch and my company, speaking to all of you out there. And I'm not quite sure what the two Leons times two, Barry Rial and Chris Wanderpool, were thinking when they thought they'd let me loose on you guys. So let's see if this works, and let those questions come in, and I'll try and answer them as accurately as I can. And hopefully I'll be done in about 45 minutes, and we'll have lots of time for questions. So please enjoy and keep those questions coming in. So I thought, seeing that we're in the eye of the storm, although some people might even tell you that we're a little bit past the eye of the storm, I'll just go through a couple of events that have happened leading up to our lockdown in South Africa. And the main reason I'm doing that, and I'm just going to skim through that, is because as human beings, we're pretty focused on what's happening around us at this point, and we tend to forget about what's just happened in the recent past, or sometimes we even use the recent past as assuming that that is what's going to happen into the next 6 months and 6 years ahead. And I'm just trying to show that we need to be careful, that we mustn't get locked down in a certain specific mind, and that we're not open to ideas in terms of moving or changing or adapting your plan that you've got in place. And if you don't have a plan, it's most probably a good idea to think of putting a plan in place in terms of your financial well-being. Okay, so if we go through the world events leading up to the lockdown in South Africa, and as I said, I'm just going to skim through this just so that we can see, oh yes, I remember that happening, but I've forgotten it again. Or maybe you do remember it very well. It doesn't really matter. It's just to give us a flavor of what happened leading into the eye of the storm in March. So on the 3rd of January, the US kills that top Iranian general, General Soleimani, you might remember, and that hit the world quite badly at that point in time. The 8th of January, the oil price spikes just because Iran said they were going to get the US back, and that's in fact what they did. They attacked some of the US bases in and around the area, and the oil price spiked. It's difficult to believe that 3 months or 4 months later, we're sitting with so much oil that the oil price is as low as it was in real terms as it was 150 years ago. Unbelievable. 16th of January, the Reserve Bank in South Africa cuts interest rates, but only by 0.25%. No inkling of the problems to come. And subsequent to that, we've had 2 interest rate cuts, both 100 basis points or 1% each. So 2.25 percentage point reductions in the first 4 months of this year, which I think you have to go a long way back in history to find that happening. 3rd of February, we see the Chinese stocks plummet because the coronavirus had started appearing in China, and consequently their stock market had a huge fall on that day. And remember this day, 3 February, because just a few slides later, you'll actually be quite surprised what happened. 6th of Feb, South African Airways cancels the slew of the routes that they're traveling on to cut costs and to see if they can't make it. Well, we know that the death knell is only a matter of days away, most probably. 12th of February, our biggest gold mine, Anglo Gold, exits South Africa. They're still listed on our stock market in South Africa, but they no longer mine here. Their last mine they sold to Harmony Gold, and they mine in the rest of the world, in places like Ghana and Australia and South America. And also around about this time, Eskom also announced that they were cutting employees, and many other firms, in fact, were also doing the same at that stage. And that was before the worst of the virus hit South Africa. On the 3rd of March, it was confirmed by Stats South Africa that we are in a recession. You will remember that in the 3rd quarter and the 4th quarter last year, the South African GDP was negative. So 2 negative quarters in a row is defined as a recession. And the bad news is that each quarter this year, the economists tell us that our GDP is also going to be negative. So I don't know how far back we have to go in our history to find 6 negative quarters in a row. So the economy not looking great in South Africa at the moment. And then on the 5th of March, just a little bit more than a month, the Chinese share market, which was hit on the 3rd of February, on the 5th of March, it hits a new 2-year high. That's how volatile markets have been and are. And it's quite amazing that in a matter of 5 weeks, the market turns around and hits a new all-time high in China. On the 5th of March, South Africa has its first coronavirus case, 30-year-old man from KZN, who'd come back from a holiday from Italy, and he'll be forever in the annals of our history. On the 8th of March, the oil war was launched between Saudis and Russia. The 8th of March was a Sunday, and you'll remember earlier on, one of the slides said that the oil price spiked when Iran attacked the US base. On the 8th of March, a few months later, the Saudis and the Russians can't come to an agreement to reduce output on the Sunday, and the oil will start the next day, Monday, the 9th of March. Sasol loses about 45% of its value in the first few minutes of trading, and it wasn't long after that they'd halved from already a cheap price in terms of where they were. On the 11th of March, the World Health Organization declares COVID-19 a pandemic. And on the 23rd of March, I think that was a Monday as well, our president broadcast to everybody watching television that evening that coming Thursday, which I think was the 27th, from 12 o'clock that evening, we'll all be staying home for a short period of time, which is now morphed into quite a long period of time. So that's what happened. There are many other things that happened. Those are just some of the snippets that I took out of a slide pack that I had in terms of how and what we've done up until now. So let's go have a look at some of the asset class performances. And if I go back to what Barry said in terms of our business, we manage share portfolios for our clients, both locally and offshore. And our view is one of a long-term view. So we don't speculate on behalf of our clients. And in fact, if we had our way, we'd like to keep the shares we buy forever. However, that's not possible. Things change, management change, companies make bad mistakes, companies make good decisions. And so there is a bit of active management, obviously, to position our portfolios. But we also do balanced portfolios, which has a blend of equities and fixed income property and so forth as well. So whenever I'm speaking to you here, I'll be speaking about the longer term in mind. And most of the graphs I'll be showing you reflects that as well. So if we look at earlier this year, equity markets were going along very nicely. We'd had quite a decent 2019 in comparison to the previous 5 years. And you can see that as we enter January, our market, which is at the bottom, was doing quite nicely. And so was the emerging market, our peers, the average of the emerging markets. And so too was the world MSCI market. And in fact, early on in January, we hit a high of approximately 59,000 on our stock market. And soon after that, we hit the problems with the coronavirus. And you can see all the markets went down without fail. And it was all panic stations. And today, almost a month ago, it was in the eye of the panic in terms of the bottom of the markets. However, we bounced up quite nicely. And I'll speak a bit about that just now again. Global bonds was also not a place to hide. Normally you find bonds are a place that diversifies your portfolio in terms of risk. But we can see that as the equity markets fell off, the bond market did react as it should, because this is the yield. As the yield goes down, your capital value increases, which is what you want to see, because your shares, the capital value is decreasing, and your bond capital increases. However, in this instance, we saw that bond yields spiked, so you weren't actually protected. But soon after that, the yields did come down, and things sort of went to normal in terms of that relativeness against ordinary shares. If you look at South Africa as well, the South African bonds also didn't provide protection because the yield shot up, which means that your capital reduced as well. So your capital in your bonds and your capital value of your shares decreased at the same time, which is quite unusual. However, the bonds in South Africa, the yields have come down slightly, but not as much as we would expect because of the fiscal situation in South Africa where our government's budget isn't looking great. Just look at some of the other asset classes. The gold price in black also dropped, but not as much as platinum. This is the platinum price. When the markets crashed, the platinum share price, the platinum price also dropped in dollars, has recovered slightly, but not very much. The gold price came down, but not by much, and has recovered back to the 1,700 levels, dollars per ounce. So let's look at what the reduction in the share market throughout the world has done in terms of valuations. Is it cheap or is it expensive? Should we run away? Should we ignore this? Or should we be giving attention to it? So I'm starting with the offshore valuations to see with the markets dropping as much as they have, is it a good time to be buying there or not? So if you look at the S&P 500, it's the largest index in the world. It's the largest 500 companies listed on the stock market in America. So it's a very good gauge of what's happening, not only in America, but throughout the world, because most companies like Coca-Cola, for instance, or Procter & Gamble, Johnson & Johnson, are all part of these 500 companies, and they do business throughout the world. So it gives you a good indication of what's happening in America, but also elsewhere. And you can see the S&P 500 going back to June 2009, just after the global financial crisis. It's had a steady climb. And with the COVID-19 or corona pandemic that was declared and created a lot of problems in the market has come off quite dramatically. And this doesn't show all the recovery that's taken place. It's back to about 2,900, so it's recovered a little bit more than what we show here at the moment. But just looking at the valuation, if you do a simple price-earnings ratio, which is fairly standard used throughout the world to determine whether markets or shares are expensive and this isn't the be-all and end-all, but it's a rough gauge of where we stand, especially if you look at it over longer periods of time. And this graph goes back into the 1960s. And you can see the horizontal line. The dark horizontal line is where we are when we on average in terms of the past. And the dotted lines are one standard deviation above the horizontal line. One standard deviation to the top means we're fairly expensive. One standard deviation to the bottom means we're cheap in relation to the past. And we can see with this downdraft in the market in America, we got to below average in terms of valuation. So nowhere near cheap where we were in the global financial crisis or where we've in fact been earlier on. So America has been expensive for quite some time. And remember, America's stock market is approximately 70% of the world market. So it has a big bearing. Japan is about 10%. So Japan and America making up about 70% of the world stock market. And and this doesn't show yet because it hasn't been updated as this is a quarterly graph. If you were to update it and it shows the recent spike in the S&P 500, you'll actually see that we're somewhere between the horizontal line and the one standard deviation up at the top. So again, not so cheap as we would like it to be buying without really paying attention. So what can we learn from history? Looking at the S&P 500 again, that index that we've just been looking at, and what has it done during recessions since 1928? And remember, we are in a recession not just in South Africa, but the whole world, because everybody's been locked down, the economies have been closed or shut, and some of them are now starting slowly to come and be revived. But we're in recession basically all over the world. And if you look at 2020, so far, and we don't know if it's over yet, and I'll speak a bit about that later on, the market dropped 34%, the S&P 500, which is the average as well for all these periods. And if we go back to 1929 to 1932, when we had the Great Depression, you can actually see the market fell 86% over a number of years. I just want to highlight, though, there are a lot of differences between what happened in 29 to 32 from what the government and Reserve Bank did those days as opposed to what they do now. And that led to the market falling much more in America at that stage than most probably would have if a similar occurrence were to happen today. Let's also remember that the Reserve Bank in America was only about 15 years old at that stage. They'd only brought and incorporated that in about 1914 or end of 1913. So they were also feeling they were still through economic challenges. And one of the things that both the Reserve Bank and the government did incorrectly then was increase interest rates and reduce the amount of liquidity in the economy, which actually sent the market spiraling down further. Whereas today, when we have a crisis like we've just been through, the interest rates are quickly reduced where they can be, and also the Reserve Bank tries to stimulate the economy by buying bonds from the government and increasing the liquidity throughout the economy, as well as the world economy from the American side. And also in many instances, as we've seen in South Africa now, the government has announced a 500 billion stimulus package to try and keep the economy going and to help it recover, which reduces the amount of volatility and also the amount that the market will most probably fall ultimately. So just to do a global summary of where we stand with equities, we think the valuations have de-risked, but emerging markets valuations are relatively attractive. In fact, we're far more attractive from an emerging market point of view in terms of our valuations, and I'll go through that as well after this. And then the prospects have improved if one looks at the American market, but the earnings assumptions, in other words, what profits are they going to be producing in the next 6, 9, 12, and 18 months is rather uncertain at the moment. And so despite the fact that the markets have gone up a lot, there is still a lot of uncertainty surrounding the profitability in the next year or so. And so one should maybe be a little bit careful, especially with putting a lot of your money currently offshore, unless it's there already, which is a slightly different decision. If you looked at the fixed interest rates, so it's things like bonds or fixed deposits, they remain extremely low throughout the world. In fact, in Germany, whether you invest in a 2-year government bond or a 10-year government bond, if you give them 100, you're going to get back less than 100 over the time that it matures. And that almost makes no sense for us South Africans, but that's how low interest rates are in other countries to the extent that it's actually negative. The prospects for fixed interest offshore is also pretty muted under normal circumstances, but remember, this isn't quite normal. There isn't much inflation. In fact, there's deflation, as Japan has seen for many years. And also your fixed interest rate often acts as a shock absorber in times of crisis. In terms of property values offshore, and I'm speaking broadly globally now, so there will be pockets of expensive property as well as ones which are cheap, but generally as an asset class, they were pretty fully priced in January, but most of them have come down quite substantially, so there is value emerging in the property sector. And the alternatives I'm not going to go through at this stage. So turning to the valuation locally in South Africa, and I just wanted to say before I start on these slides, which looks specifically at the South African market, the South African market is an emerging market, and we fall into the box of emerging markets throughout the world. And I don't have time, unfortunately, today, but I do have very many slides where you can see that the emerging markets generally follow each other quite closely, despite the fact that we sit here and we think, oh, because we have Jacob Zuma as our president, we're the only ones that have those kind of problems that befell our economy and our country when he was here. You've got guys like the current president in Turkey, who's causing his own problems. You had Argentina, which is has its own problems as well. So if you look at the emerging markets as a basket, we all seem to have similar problems, and we actually follow each other quite closely in terms of the return on our market. So whatever I'm saying here about South Africa is actually generally true for the rest of the emerging market basket. And that includes China, which is also an emerging market for stock exchange and investment purposes. It includes countries like Russia, Brazil, Argentina, Indonesia, and India as well. So if you look at the South African equities in rand terms, we've gone sideways for about 5 to 5.5 years. And over that period of time, although our economy wasn't growing great guns, the companies that are listed on our stock market were generally still making profits year on year, which means that as the market, the share prices were going nowhere, the companies were earning more money. We were actually becoming cheaper and cheaper over time, whereas in America, that wasn't the case. The market there has just been flying. But despite the fact that we were relatively cheap in January, before the crisis hit us, it didn't spare our market either. And the blue line is the All Share Index, which is the top 160 companies in South Africa. In that line, you can see we got smacked hard. We've recovered somewhat now. And the black line or dark line is actually the share price of Naspers, the biggest company on our stock market. And you can see that although it also fell rapidly, it actually recovered quicker. And if I were to do this up until today, Naspers is actually at a higher level than it was before the crisis in January. Very good recovery. And one of the reasons for this is because Naspers' assets are, if you can call it, new economy kind of assets, where a lot of the revenue that they earn comes from people being on the internet and playing games and ordering stuff via internet channels. And that's why the market likes it so much. Looking at South African equities on a price earnings basis, which is similar to what I showed you of the S&P 500, also the horizontal line, that's where we are at fair value or average in terms of the past. This doesn't go quite as far back as the one in America that I showed you, but it goes back to about the beginning of the new government ruling in South Africa. You can see that at the moment, we are down 1 standard deviation below the horizontal line, which in fact gives us a very cheap valuation if we look back. However, as with the other one on the S&P 500, we bounced off that line a little bit as we are up about, I think it's 25 to 30% from our lows that we hit on the 23rd of March. So we're also not on that dotted line anymore. We've also bounced up, but we're still below fair value, as it were, that horizontal line represents. Looking at a summary in South Africa then, the equity side of the equation, the country as a whole, the macro environment doesn't look very good at the moment. There's a lot of unemployment. Our economy is growing slowly, and we just have a lot of structural problems. And this is really the opportunity now that we're getting the IMF involved in our economy, because we need money from outside, and they're going to provide us with a couple of $2 billion that we can restructure the economy. And I think our finance minister, Tito Mboweni, and our state president have a golden opportunity to restructure here. And one of the things which they've already done because of the pandemic was to reduce the large government service that we have. The amount of employees is actually far too much, but what they have done is not given them any increases recently. Now, I feel that my heart bleeds for those that are in the health sector. They've been working their butts off over this period of time, and they're probably still going to. But there are a lot of our other public servants which are actually there for the ride, and this gives our politicians a great opportunity to restructure for the future. So our equities look relatively attractive, especially in terms of the past, but also looking at the American market and the other first world markets. And there are selective buys which you can do. And if you're cautious, I think you can do very well. On the fixed interest side, our fixed interest rates are still very attractive. You can buy a 10-year government bond that will yield over 10% per annum. and you can get some capital growth between now and 2030 when it matures. So there's opportunities there as well. If one looks at the fiscal risks, though, that is the unknown, and that's one of the reasons why the yields on fixed bonds is actually quite high, because our budget, as I mentioned previously, is fairly precarious. But with the extra money coming in from offshore, that will help restructure, and I think over a period of time, we'll do quite well. If we look at property, our macro environment in South Africa, wherein these guys have to operate, is very poor, and the property shares as a result have fallen a hell of a lot, and in fact haven't recovered really to the same extent as the rest of the market. And that's really because the market is concerned about their balance sheets. And as you have all read and heard, many tenants at the moment paying a reduced rent, or in fact aren't paying a rent at all, and therefore it makes it quite difficult to discern which kind of property share one should be looking at to buy at this stage, because you're not quite sure whose balance sheets are going to make it and who's not going to make it. That's all on this slide that I'm going to cover. If we look at recommendations, then just to firm up on what I've been saying in terms of recommendations, we think you can add to local equities, but be more circumspect if you're adding to your offshore equities. There is a bit of risk, or higher risk there, because the valuations aren't so great as in the emerging markets and our market. And we think that if you've been holding a lot of cash, you can reduce that to fund the equity purchases. In Sanlam Private Wealth, we always target, and that's also a Regulation 28 level, a 38% foreign exposure. But obviously that depends on your personal circumstances, and the guys at Good Forsure can give you a good indication in terms of your personal circumstances where they think you should be heading, and help you with that plan. Property in South Africa looks very cheap on a number of various valuation measures, but selection is crucial, as there will most probably be some of the property shares which are listed on the market which might not make it, but they'll most probably be gobbled up by the bigger ones that do in fact make it and do have the balance sheets to accommodate that. So property has always been a good diversifier, and also provided you with, especially in your Reg 28 portfolios, with a nice level of income that grows over time as well. But unfortunately, for a short period of time, you're going to get no yield out of those companies, as they also have to try and survive and see how they can keep their balance sheets all intact and stay in business. Because I thought it's instructive to also just do an equity case study to see how we look at companies and the kind of analysis our analysts in Cape Town do for us. And one of the sectors which hasn't really recovered all that well, with the property sector, which also hasn't recovered much, is the banking sector. So I thought I'd pull up Standard Bank and use that as an example of how we work in terms of looking at valuations before we necessarily buy or stay in this kind of share. Now, Standard Bank has got a long history, and this slide goes back to January 98, and is the price earnings ratio, similar kind of valuation that I showed you in terms of our whole market and the S&P 500 market earlier. And you can see that when this blue line is low, that's when Standard Bank is very cheap on its price divided by its profitability. And in fact, all the way back to 98, this is the cheapest level it's been. So it's even cheaper than the global financial crisis when it hit 7. In September to May 2003, it also hit 7. And in the Asian crisis of 98, it also hit 7 back then at that stage, coming down all the way from over 20. So we think on a price earnings ratio that Standard Bank is very cheap, and especially if you look at it at the past. These slides are a little bit technical, but I'll go through them a little in depth. So if we look at the price to book ratio, many analysts and commentators will tell you when you look at a bank, you shouldn't value it necessarily on a price earnings ratio. You should rather look at it from a price to book ratios, and that's why I'm showing you both. So if you look at the blue line, that is the maximum level that that particular bank has hit between 2008 and 2019 in terms of its price to book ratio, the most expensive it's been over that 11-year period. So ABSA on the left, it's been up as high as 2 times its price to book. Standard Bank was at 2.2 at its highest. Nedbank was 1.8 and FirstRand was over 3.8, their book value. If you look at the minimum that the book value was also over that 11-year period, and this will all be in the global financial crisis when they hit their lowest levels, and that's that dark or black line, or black bar, sorry. ABSA's was 1.1 in the global financial crisis, Standard Bank 1.2, Nedbank 1, FirstRand 1.3. And then if one looks at this brownish bar column, you'll see that that's the current price to book ratio. And in all the banks in South Africa that I'm showing here, other than FirstRand, it's the lowest it's been over the last 12 years. Another indication that our banks are very cheap in relation to their past. But obviously people are concerned because with the economy being locked down and closed, there are a lot of people that aren't going to be able to pay the loans that they have, as well as the property sector as well, who've got large loans by the banks. So in terms of their capital adequacy ratios, I'll show you this, and also then the bad debt exposures that they have. So if one looks at the capital adequacy ratios, it's the same banks, ABSA, Standard, Nedbank, and FirstRand. And you look at the Tier 1 capital ratio, which is the most important and which is the Reserve Bank looks at very strictly. You'll see that going into the global financial crisis in 2008, 2009, their Tier 1 capital in 2007 for all the banks, ABSA was 10.1, Standard was 10.4, Nedbank 7.2, and FirstRand was 10.7. Going into this crisis, which we are currently experiencing, you can see that's the blue bar, and in all the banks in this instance, the capital adequacy ratios are far higher going into this crisis than the previous one. So our banks are well capitalized in terms of being able to withstand financial stress, and we think that the market is overly negative on them at this point. And just to confirm that point of view from Sanlam Private Wealth, if you look at the amount of capital that you need to shore up because of possible bad debts, that's what this is all about. So here all funny CET1 ratios, it's got to do with providing for bad debts. If one looks at ABSA, FirstRand, Nedbank, and Standard Bank, I'm not quite sure why we've changed FirstRand and Standard Bank, I apologize. But if we look at the height of the global financial crisis, the peak ratio that the banks made provision for bad debts, you will see that in ABSA's case, they provided of their total asset book 1.74 they thought would go bad. In FirstRand's case, they thought 1.8% would go bad, Nedbank 1.5, and Standard Bank 1.6. The actual credit loss ratios, the amount that they have put away going into this crisis, is this brownish bar, and you can see 0.8 for ABSA, 0.86 for FirstRand, 0.82 for Nedbank, and 0.68 for Standard Bank. Now, to understand this graph fully, you must appreciate that the amount of capital that the banks hold needs to drop to 9% before the Reserve Bank becomes edgy. And the Reserve Bank has given the banks further credit lines as well. So we're far away from that at this stage in terms of dropping down to 9, because as I showed you here, we well capitalized on all the banks, over 11 for ABSA, over 14 for Standard. It's the best and most well capitalized at the moment. Nedbank is over 11% capital, and FirstRand 12. Coming back to this slide, at the moment, if these banks here were to drop to 9, this is how much they need to provide for bad loans in each instance. So the bad loans in Standard Bank's case in the global financial crisis went up to 1.6. Today they can go up to 10% before we hit the 9% where the Reserve Bank is going to start feeling uncomfortable. So all the banks, all our large banks have got more than sufficient capital at the moment, and they've also got more than enough headroom to provide for losses, because I do believe, and many other commentators as well, that their bad loans and bad debts are going to be quite higher than the global financial crisis, simply because the world economy has been in lockdown, which it wasn't in the GFC, the global financial crisis. The world economy slowed drastically then, but the Reserve Bank and other banks throughout the world pumped a lot of money into the economy and got it going again. Whereas currently, most of the economies throughout the world have been closed for a period of 4 to 8 weeks in some instances. So the bad debts are going to be higher, but our banks are very well capitalized to handle that. The other problem, of course, is dividends. As a result of the current environment, the Reserve Bank has asked the banks not to pay out any dividends, and some of them will and some of them won't. But the fact is many people rely on those dividends, and that's also causing them to sell their banking shares. However, we do believe in a short space of time, whether it's 6 months or 9 months, when business resumes to more or less normal, that we'll be receiving very good dividends if you were to be paying the kind of prices that the banks are today. So then I just thought, looking at the Rand US dollar, as I know from presentations in the past when I wasn't speaking to my computer and I could see the people who I was speaking to, the Rand dollar is something which is high on everybody's mind. So this graph is not so difficult, although it might look difficult, but if one looks at what the economists call purchasing power parity, which is really a phrase to say that a hamburger at McDonald's in South Africa and in America costs more or less the same, were you to swap the currencies out. And at the purchasing power level, we'd be on the red line in this particular graph. And you can see that red line slopes up. And as it slopes up, it means the Rand is depreciating against the dollar. And the reason for us depreciating against the dollar really is the fact that our interest rates are high, but more importantly, our inflation is higher than America. And consequently, over time, we do go down in value or depreciate in value. But the other interesting thing is the blue line is the actual value of the Rand versus the dollar. And we can see in 2001, 2002, our Rand blew out. A lot of people took money out to invest offshore, and then our Rand decided to strengthen, and the market in America went down. So they don't have a very good experience of taking money offshore. And we see most times when the Rand actually blows up like it has now, and we're now more than 3 standard deviations away from purchasing power parity, which is at 13.45. I think we're about 18 Rand 60 today. Means that if you take money out today and the Rand strengthens and the market in America doesn't do so well, then you're not going to be looking so great in terms of your investment performance. So just be careful in terms of investment decision to take out a lot of your money now if you want to just start doing that at this stage. I'm not advocating that you shouldn't have money offshore. In fact, you should. It helps for diversification. There's also there are many opportunities offshore which you can't necessarily get in South Africa. And then just some concluding thoughts and also some homework if I don't get around to it, because I see I'm talking a bit long, but maybe some of the questions will address that as well. So what can we expect in terms of returns in South Africa over the next 5 years? And this gives one some sense of what's happened in the past. So if you look at the far right-hand side here, 2020, our market dropped about 34% from its high now. In January to 23rd of March, we've recovered quite somewhat. But if you look at the past, you'll see that the red bars are actually a little bit thicker than the current one. And that's really because we spent a certain amount of time in the minuses. And if one just takes this as a rule of thumb and says, and looks either how far we've fallen or how thick the red downdrafts are, the thicker it is, the better we seem to do in the next 5 years. And the green percentage is the subsequent 5-year return that you've achieved on our stock market after you've seen a panic and a crisis of a drawdown similar to what we've had now. So if you look at the 70s, when we had the oil crisis, which many of you might remember and recall, we also had high interest rates as well. You can see that from top to bottom, we were down 42% at our worst, and the following 5 years, we were up 579%. In 1982, when the gold price collapsed and also interest rates spiked, and the market dropped 44%, the subsequent 5-year return was 739%. In South Africa, in 1987, when we had Black Monday on the stock market in America, our share market in South Africa dropped over 47%. The following 5 years, we were up 257%. Those two little ones, I'm not sure what the downdraft was. In 1998, when we had the Asian crisis, which was a debt crisis, it started in Asia, in Indonesia, in fact, spread to Russia, and a lot of other emerging markets, including Argentina, fell over and couldn't repay their foreign debt. And it was mostly in the emerging markets that the problem was. We dropped 45%. The next 5 years, we were up 154. 2003, when the rand collapsed, as well as the stock market, the tech bubble, as you guys will remember in America, the market dropped 28%. The next 5 years, we were up 353. And then the global financial crisis, down 42%. The next 5 years, 175%. Now, I don't know where the market is going to go in the next 5 years, but if you have a cheap market like we do now, you'll most probably have better returns over the next 5 years than what you have received over the past 5 years. And I'm also not saying that the current crisis is over. Very often we do have a nice rebound, and then some other negative news comes out again, and there's a second panic, and we go down and test the levels that we were at our lows. Sometimes we go a little bit lower, sometimes we turn before that. It does seem that at this stage, with all the liquidity accommodation into the world economy, as well as lower interest rates, that even if we do go down again, it might not be quite as bad as what we've experienced. So I thought I'd end off with something like this. By Blaise Pascal, all men's miseries derive from not being able to sit in a quiet room alone, which has many meanings to many different people. So some people can't sit still and they always have to do something. Or sometimes you just need to sit still. If you have the right plan in place, if you've been speaking to one of these guys at Good Forsure, they put a plan in place for you, you'll most probably find that you have to do very little to that plan. Some of you might not have a plan and you actually want to do something. This is your opportunity to speak to those guys and put a plan in place, or maybe you need to make slight adjustments to your plan because the amount of equities that you have in your portfolio isn't as much as you'd like at this stage. So who was Blaise Pascal? He was a French mathematician, physicist, inventor, writer, and Catholic theologian, and he lived in 1623 to 1662, and he's quite well known in terms of his sayings. So maybe just a little bit of contemplation on your side. And then lastly, I have two graphs of the JSE over the long term. And the reason why it's two graphs is because it can't fit into one. And it goes all the way from 1960 until the current situation. It shows you all the crises we've had locally. But the point I want to make is that if you look at this graph, you'll see that it started around about 50 points in 1960 or 55 points in 1960. And today, as I speak, we're standing at 50,000. In January, we were at 59,000. The point is it goes up over time. It outperforms inflation by a large margin, but it doesn't always outperform inflation. And so for that better return over the long term, you have many times where you're uncomfortable, the market goes sideways like the last 5.5 years, and you give up on the asset class. But you shouldn't, and I think you should reconsider if you're in that boat today. So that concludes my formal presentation, and I'm going to look at some of your questions. So one of the questions I have here is, what is a good long-term strategic asset allocation for local versus offshore exposure? Very difficult question because each person's situation is slightly different. And for me to explain it in simple terms for myself to understand is, say, for instance, you have 200 million in investable assets. It doesn't really matter where you invest it because it's a lot of money and you can more than likely live off the dividends, whether it's here or offshore. And someone with 200 million will most probably have a bigger percentage offshore than alternatively. If you perhaps only have 10 million in assets, investable assets, and your liabilities are all in South Africa, it's probably better to have most of it here. However, your starting point is extremely important in terms of your future returns. And if you look at the returns achieved in emerging markets the last 5.5 years, the returns are dismal in comparison to America. So now we all want to go to America because that's where we feel comfortable. But the fact of the matter is the assets there, shares, are expensive in relation to emerging markets. So be careful in terms of not allocating too much money to the offshore market. And I just want to go back to this graph as well, where you can see the rand versus the US dollar is not at a favorable point to take your rands and to swap it to dollars at the moment. So be careful in terms of doing too much. And if I look at the rand versus the pound and the euro, we're about one standard deviation from where we should be. We're about over there if you look at the pound and the US. A second question. If I have 1 million currently sitting in cash, how would you go about investing the lump sum? Is there enough opportunities to invest the whole amount, or should it be phased in? I always prefer a phased-in approach. There are many people that will disagree, but as there's such a huge amount of volatility in our market, it does normally give one an opportunity to phase in. And looking at it from my perspective, where I'm working with shares mostly, if I have a 1 million portfolio that a client were to give me to invest, I will work out the shares I want to hold for that client for the 1 million, and I will phase each of the shares into the portfolio as I see value in relation to where it's been recently. So I prefer a phased-in approach as well. And the phased-in approach is also maybe easier for our minds to absorb, especially if you're taking money offshore or even if you're putting money into the market. So if it goes about unit trusts, you can most probably phase in over a 3 or 6 month period. But I must say, if I look at our market where it is, I tend to phase in a shorter period of time than I would else otherwise because of the market being so cheap. So unit trust, I'd most probably phase in over a 3 month period. I've got another question. What about Capitec? I don't know if you, I suppose the question is it a good investment or not? So let's be clear on this. Just because a company is managed very well and has a very good track record and is doing extremely well, doesn't mean to say I want to invest in it. Because when you look at it from a valuation basis, and I didn't cover it with the other banks, is because Capitec is very expensive in relation to the ABSAs, the standard banks of this world. And the reason for that is because it's a younger bank. It's been growing its profits at a much higher rate, more rapidly than the other banks, and consequently has been given a much higher rating. But as a company, whether it's a bank or any other company, becomes bigger, to grow your profits by 20% year on year forever becomes more and more difficult. And in Capitec's case as well, they are busy expanding the amount of products which they offer their clients. So as they expand that, they become a little less efficient, and also the margins on those products are slightly less than their traditional margins. So over time, I would say the growth of their profits will come down, and consequently, you will find that there will be a period of time which their share price most probably goes sideways rather than up, despite the fact that they're showing profits, but just because they're relatively expensive at the moment. So it's not, for me, a great investment. I think the price is too expensive. I'd rather go for something like Standard Bank. Another question, I may have missed opportunities on Sasol equities. Sasol is a very interesting one. I thought it would be one of the first questions. I'm quite surprised that we're only coming in at number 4. Sasol is a very interesting one because of the problems that they have. So I'm just going to put it in a nutshell. When one looks at Sasol's balance sheet, they have a tremendous amount of debt. And that debt is obviously owed to somebody. And the people that they owe that to said, one of the things that they are very strict on is if the debt exceeds a certain level of their profitability, then they're going to feel uncomfortable and they want Sasol to pay that debt back. Obviously, that's like a bank wanting to take its money back that it's loaned you because you're in financial difficulty and you can't pay it. And that's ultimately where Sasol is sitting at the moment. So the debt, as they call it, debt covenants, and we must make the distinction here. It's not got to do with can they pay the debt back. It's just got to do with the ratio of their debt to their profits at the moment. Out of their cash flows, they'll be able to pay their debt back over time. But the people that have lent the money want to have some form of control over how they run their balance sheets. And that's what's playing out over here at the moment. So they're in the perfect storm at the moment with the oil price collapsing. They have a lot of debt at the same time because of the Lake Charles in America. And the lenders are saying, but you're going to start breaching our debt covenants and you need to stop, and you may need to start paying us back. And that's why the market is uneasy with Sasol share price and why it dropped to such an extent. However, it is our opinion that Sasol is going to make it. The only negative is that they might have to have a rights issue to bring in some more money to make their lenders feel comfortable. And if they have a rights issue, it means that if you own Sasol shares at any given time, you're going to be given the right to buy more shares at a certain price. And the more shares in this case is most probably, say for instance, you own 1,000 shares at the moment, you'll most probably be given the right of anything between taking up an additional 1,000 to 2,000 shares. Currently, it looks like the price might be around 50 Rand, and that's what was worrying the market as well. However, it looks like they've done quite well in terms of hedging the price that they receive for their oil that they make for the fourth quarter of their financial year. And it also looks like they're making good progress with talking to their lenders who've given them money to do the Lake Charles, to back off a little bit on the debt covenants, give them a little bit of breathing space to enable them to conduct their business well. But ultimately, we think Sasol is worth a lot more money than it's trading at today. I see it was up about 18% at one stage today. So I think the market is getting comfortable with the fact that Sasol will most probably make it. We're just not quite sure if they're going to have that rights issue or not. Okay, so the question that I answered now also goes on to say, will the price go down and by how much before I buy in? Sure, I wish I knew if the price was going to go down. But if they are going to have that rights issue, and it really depends on their lenders, if they will extend them or give them an extra period of grace or not. If they don't give them an extra period of grace, with the oil price where it is now, we'll definitely have the rights issue, and then the share price will come down again. If we don't have to have the rights issue, and that's nobody really knows at this stage, the price will probably not come down by all that much from the current levels, because Sasol is inherently worth a lot more than the current 77 Rand. So the next question, SPW also invests in unlisted companies. Does this cause liquidity issues in current market conditions? Are you seeing any good opportunities in this space? So we do invest in companies that are not listed on the Johannesburg Stock Exchange, and we have to go through a very rigorous progress. And it's an initiative by the Pretoria office to actually do this. Our other offices don't really do this. And the reason that we do this is that anybody can go out and buy good quality companies on the stock exchange in South Africa. To add a little bit of spice and give you extra return over a period of time, we go and look for these special situations, and we invest into those specific situations for our clients. And unfortunately, in terms of the question, when it comes to liquidity, there is the possibility that in times like these, and it really depends on the company as well, that there could be extra shares on offer in terms of what the market is selling, and there aren't sufficient buyers at that specific price that the sellers want to sell out. And currently, we own Acorn Agri in our portfolios in Pretoria. And as you can hear, it's invested and does business in the agricultural sector. And because of the fact that they are involved with co-ops, as we used to call them in the past, there are a lot of farmers and people in the agricultural sector who own shares for many years in these co-ops. And because of the recent drought and also the current lockdown, a lot of those farmers are in distress in terms of cash flow, and they are selling their shares more so than they would normally. And that has put that specific share under pressure. But so has the market been under pressure. But the problem is there are not always sufficient buyers for the amount of sellers. So it's not always so easy to sell your shares as it would be, for instance, trading a company like Sasol or Anglos or Billiton. I think that's all the questions at this stage, Barry. I don't know if there's something else you'd like me to cover.
Thank you, Peter. Yes, that was great. We actually have run out of time, so we really try and keep this to the hour. A lot of people have got appointments further on, but thank you for adding this. I think a lot of our clients and people that's been listening in have a little bit of a better understanding of where the local equity markets are compared to global equity markets, and might think twice before just running abroad with investments or whatever the case might be. So thank you once again for your time. To everybody that has joined us, thank you for coming in. If there's anyone that needs to speak to us or would like to talk to us about investments, direct equity investments, please feel free to send an email to info@goodforsure.co.za, and one of our advisors will get in contact with you and assist you. And if there's anyone that's listening, new clients, existing clients that needs to get in contact with us, we are here. We would like to talk to you. We would like to assist you. So please get in contact with us. And once again, thank you, Peter. We really appreciate your time and efforts with this presentation.
My pleasure. It's been great. Thank you, Barry.
Great stuff. So that's the recording of the live conversation with Mr. Peter Duminy from SPW, Sanlam Private Wealth. So if there's anyone that would like to get in contact with one of the advisors to get more information about direct equity investments, write down the info on the screen, info@goodforsure, and we'll be really glad to assist you. Thank you for watching, and please subscribe to our channel for more information.